Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Let's go through the spot currency conventions. A lot of you that trade the spot markets, you know what these are. And we have symbols that you would type into with your equity options broker to get those spot conventions. So AUM, GBP. So AUM is going to be equivalent to the AUM divided by the US dollar. We multiply that by 100. So we come up with an index value, if you will. A lot of you are familiar with dollar Canadian. The symbol is CDD. Euro dollar, EUU. Dollar yen, yuck. Dollar Mexican peso, PZO. New Zealand dollar, US dollar, NDO. US dollar, Swedish krona, SKA. And the Swiss franc, US dollar against the Swiss franc, SFC. We have, for those of you that are interested in the dollar-based currency conventions, we have those. Some people like to look at it from the dollar's perspective. So what is the dollar worth? So we have AUX, BPX, CDD, EUI, YUK, PZO, NZD, SKA, and SFC. And then we have the quote currencies, and these, of course, are popular in the spot market. And I mentioned these. AUM would be the Australian US dollar. GBP is the British pound over the US dollar. Euro is the symbol is EUU. It's euro over the US dollar, and then the New Zealand dollar is symbol is NDO, and that's New Zealand dollar over the US dollars. So let me just summarize the first part of this webinar. Base currency, quote currency, because we have two different currencies in the currency pair. You need to think in terms of what your view is on the base currency. So if you're bullish on the base, you might want to be buying calls. For limited risk, you can sell options also. You can sell puts, but there's a lot more risk in doing that because you have the ability to lose a lot more than you could when you buy calls. So you need to think about the risk reward. And also you have to have a margin account open to sell options naked. So the first trade for many is probably looking at the buying side of this. Selling is available. You just need to have enough capital, and you need to be approved to do that. If you're bullish on the base, you'd be buying a call. If you're bearish on the base, you'd be buying a put. Buyers, they pay premiums. Sellers receive premiums. Buyers, one of the biggest benefits for a buyer is that they have limited risk. Sellers have unlimited risk, and a buyer, if you're buying an option, you're expecting movement in that currency pair. If you're a seller, then you're expecting a lack of movement. Getting back to the option. We're trading rights and obligations. Someone that buys an option has the right to exercise that, but they don't have to do it. It's not something that they're forced to do. It's a right, but not, they're not forced to do it. And their option buyers are called holders. Sellers receive obligations, but they receive these premiums also. So they might end up selling the exchange rate at that certain price. They might end up buying the exchange rate at a certain price. Sellers are targeting income. Buyers are targeting limited risk. Different risk-reward payoffs for buyers and sellers. Sellers are hoping that the market isn't going to move that much, or, of course, if you're selling a call, you hope the market moves down. Selling a put, you hope the market moves up. And not sure if a lot of you have heard this, but when I give live presentations, people ask me, Steve, isn't there an advantage to being a seller of an option? Theoretically, the answer is no. According to options theory, there's no advantage to being a buyer or a seller. The seller might win more often, but when they lose, they're going to lose more money. So it all balances out. Of course, you, as the investor, have to decide the risk reward you want to put on. It's not appropriate for me to tell you you should be a buyer or a seller of an option, but you need to just educate yourself to understand the risks and rewards of the trade. so you can figure out what's best for you. When you make a transaction, there is an opening transaction. That's the initial trade. So if I buy a call option on the U.S. dollar Canadian, I'm buying to open. I think that the U.S. dollar is going to rally relative to the Canadian dollar. If I change my mind a week or two from now, I could sell it any day that the IFC is open. That would be a closing transaction. So I buy a call to receive these rights. I could buy a put, of course, if I thought the dollar was going to sell off relative to the Canadian dollar. Or I could sell a call. I'd receive obligation. I'd sell a put. To change the trade, to close the trade, you just do the reverse of your initial transactions. If you bought an option, you just simply sell it. If you sold an option, you just simply buy it back. And this table, I think, does a great job in explaining this. So what you're getting here is that buyers, the benefit is that they have limited risk. They either have the right to buy or the right to sell, depending on if it's a call or a put. Sellers are going to receive option premiums, but they're obligated to sell if the market moves up, and they're obligated to buy if the market moves down. And when I say obligated to buy, this is a cash-settled product, so you're not going to have to deliver Canadian dollars or Japanese yen or anything like that. It will be a cash-settled process, and then that cash-settled process will be in U.S. dollars. So the second part of the trade is the closing transaction, and I went through that. It's just the reversal of the beginning part. And that will terminate your rights or obligations of the original transaction. So just to summarize, option buyers have rights. You have the right to buy or sell the exchange rate at a certain strike price for a certain period of time, and you pay a premium for that. You pay the seller. The decision to exercise is going to be up to the buyer. Now, these are cash-settled options, so these are going to settle into cash. So if an option has some intrinsic value at expiration, your broker will notify the OCC, and basically, if you do not close this trade out, you will receive funds. If the option is worthless and you're long the option, you will just lose your entire debit or the amount that you paid for that option. So the most you could lose for any option when you buy it is the amount that you paid for it. If you sell an option, you could lose an amount much greater than that. Options are contracts giving the seller the obligation to buy or sell the exchange rate, in this case, at a certain strike price for a certain period of time. And for this obligation, the seller receives the premium from the option buyer. So why would you trade these options? Well, you have limited risk. So in the spot market, you have theoretically unlimited risk. I know you could use stop-loss orders. What happens is that sometimes people will continue to trade in the same direction. Options give you the ability to select your own risk-reward that you feel is appropriate. I also personally think that options give you the ability to have a little bit longer-term view relative to the spot market, where you're basically looking at the next couple of minutes, seconds. An option, you can go out 10 months. If I believe that the dollar versus whatever other currency was going to have some sort of move, I might not be right today, but if I buy this option, I know that my biggest risk when I buy this option is that I'm completely wrong and I could lose my entire debit, but I can't lose any more than that. Options allow for the transfer of risk, so traders can hedge their exposure to the spot FX market. And I showed you some of the spot conventions. If you choose to, you could do that. You buy calls or puts to hedge your position in the spot market. You could also trade spreads, and we're going to get to spreads not tonight, but in a future webinar, we'll be talking about spreads and the benefits of spread trading, how you can create unique payoffs, how you can decide really what risk-reward balances you want to, or trade-offs you want to create.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.